Hello everyone, I'm Yuhang. Today I will talk about the FIN451, the company analyzing product. The two industries I choose first one is the fresh ferment market industry, and the second one is the department store industry. The fresh ferment market industry is the industry which one specializing in natural and organic food as time goes on. This industry expanded its area to the organic personal care and some healthcare drugs. This industry is a newly developed industry. The investor for this industry has optimistic attitude for its growth. The five companies I choose first one is the whole food market industry, founded in Texas 1980, and the second one is Sprouts, founded in Arizona in 2001, and the third one is the Fresh Market, founded in North Carolina 1982, and the Natural Grocery, founded in Colorado 2012, and the last one is the Kroger, founded in Ohio in 1983. But this Kroger is the last one. Kroger is a big supermarket. Not only sells fresh product, but the fresh product occupy his big part revenue. And as we know, for the productivity part, I calculate the return on equity of these five companies from 2010 to 2014. On the chart, we can find the orange line Kroger and the green line Fresh Market has outperforming than the industry average. But as we know, the debit leverage magnifies the profit and also magnifies the loss. As we know, the return on equity equal to the return on asset times equity multiplier. If we raising the equity multiplier, that's raising the return on equity. But that's not about the management operation ability. So if I want to measure how this company operation, we need to just watch the return on asset, not only the return on equity. On the equity multiplier, we found the EM of the original Kroger is very high than the industry average, and for the Whole Foods market, the EM is much lower than the industry average. So we can conclude. So we can see on the ROA on my chart, for the Kroger, its ROA is decreased by the very high equity multiplier. But for the Whole Food, the blue line, its ROA increase over than the industry average because its equity multiplier is lower. So on the ROA, we can see the green line Fresh Market and then the blue line Whole Food Market beats the industry average. So what caused the ROA of these two companies beats the industry average? As we know, the return on asset equal to the total asset turnover times the profit margin. So we see it on the total asset turnover from 2010 and to 2014. We can see the Fresh Market has a good total asset turnover, and the Kroger also outperformance than the industry average. But for the Whole Food, the total asset turnover is lower than the industry average. But the Whole Foods has the good bigger ROA, so we can see the profit margin. The Whole Food has a very high profit margin, larger than the industry average. So we can see the Fresh Market is do very well for both in total asset turnover and the profit margin. And as we know, the stock price reflects the investors' confidence for the stock. So I calculate the price to earning ratio and price to book value ratio to measure these five companies. In the both charts, we can see the blue line of Fresh Market has a steep negative slope. So we can conclude the investors are losing confidence for the Fresh Market. But for the blue line of Whole Food, this curve is just stable from in past 5 years. So I think the investors has pretty much confidence for the Whole Food. So between the Fresh Market and the Whole Food, these two companies has a higher ROA ratio, my favorite company is Whole Food Market because this company's stock price is stable in past 5 years. And on this divided discount model, we also can see the theoretical price use this model to calculate the whole food price. Stock price is $35, but the actually stock price is 47% dollars. So we can also conclude the market have pretty much confidence for the whole food to drive its price up. And the second industrial truth is the department store industry, which is a retailer establishment with a building open to the public, offering a wide range of customer goods. It typically allows shoppers to choose between multiple merchandise lines at variable price points in different product catalogs known as departments. This industry has a stable income and metro business environment. In 2008 to 2010, this industry suffered big loss in the financial crisis, but after 2010, this industry gradually recovered. The 5 companies I chose, first one is the Northdown, which one is founded in Washington 1901, and the second one is Dealers, founded in Arkansas in 1938, and the Bolton, founded in New York in 1898, and TJ Maxx, founded in Massachusetts in 1976, and the last one is Macy's, founded in New York City in 1858. As we can see, these five companies are very old than the fresh markets industry companies. So the profitability part of this five company, first I also calculated the return on equity, and we can see the TJ Maxx and the Northdown has outperforming than the industry average. So as we know, the equity multiplier will raising the ROE, so we will also see how the equity multiplier of this 5 companies. As we see, just this one, the Bolton stock has a very high equity multiplier than industrial average, and the other 4 is its equity multiplier is pretty same. So and also in the ROE, we can see the green line of Bolton is very low. So if a company has a lower ROE but has a very high equity multiplier, so we can conclude its ROA of Bolton is very low. So as we see in the ROE chart, the blue line of Bolton is very low. It's nearly 0. And in the ROE pattern, there is one company outperforming than the industry. That is TJ Maxx, the purple line. So TJ Maxx is very well in this whole industry. And as we know, the ROA is equal to the total asset turnover times profit margin. So we can see which contributes the TJ Maxx has a very high ROA. And in profit margin part, we can see except the Bolton, the other 4 companies' profit margin is pretty the same, and the Bolton profit margin very low. So this causes the Bolton has a very low ROA, but in the total asset turnover part, the TJ Maxx total asset turnover is very high. So this one causes the TJ Maxx high ROA, and as we know, the stock price reflects investors' confidence. In the two chart, price per share chart and the price to book value chart, we can see this line for TJ Maxx is increasing from 2010 to 2014. So we can conclude the investors have increasing confidence for the TJ Maxx stock, but we need to focus on these 2, the blue line for Dealers and green line for Bolton. The price to book per share ratio is nearly is around 1 from 2010 and 2012. That means this company's stock price is almost equal to its book value per share, or sometimes even almost lower than its book value per share. So that means the investors have no confidence for this company's future. But as time goes on, after the 2012, the two companies start price to book ratio a little increasing. So we can conclude the investors have recovered their confidence for these two companies. And for the divided discount model, the theoretical price of T-Max is $52, but the actual price is $65. So, and also in this part we can also calculate the stock markets have very optimistic confidence for the TJ Maxx, and between the two companies, the Whole Foods and T-Max, my favorite company is the TJ Maxx. As we see, the return on asset ratio of TJ Maxx is higher than the Whole Food market, and the total asset turnover ratio and the profit margin of TJ Maxx is also higher than the Whole Food market. For the investor confidence for these two companies, in this chart, price to earning ratio, the Whole Food market has a higher price to earning ratio than the TJ Maxx. So we can see in the investor have more confidence for the future of the fresh market industry. So even now, the Whole Food the earning per share is not very high, but its stock price is very high. That's why drive the price to earning ratio is high. But in the price to book value chart, you can see the TJ Maxx price to book per share value is higher. So this one is also reflects the confidence, the investors' confidence in TJ Maxx is much more than in the Whole Foods. And for this one, the EV spread, the TJ Maxx is about 6%, and the Whole Foods is only sometimes it's around the 0%. So that means the TJ Maxx every year net operating profit is higher than its cost of capital. So in conclusion, between the two industries, my favorite company is the TJ Maxx, which one has a higher ROE ratio, and its price to book ratio is very high. Yeah, for the selection management part, for the TJ Maxx, because this is a retailer store, so its consumer is just every individual. So it's just an individual. But in the supply part, we can see this company has many suppliers, but each supplier just contributes a smaller part of TJ Maxx revenue. So I think this structure is very healthy because your revenue not just occupies a single company very too much. So this is all. This is my project. Thank you everyone to listening.